Good afternoon. Thank you for joining our webinar today. My name is Rich Alterman, and for those of you that don't know me, I have been with GDS Link for 11 years now. Joined the company in 2009. In my current role, I am focused on strategic partnerships and assisting with new business development. I want to thank you all for joining our webinar this afternoon entitled Mitigating Losses on Bankrupt Accounts. One of GDS's objectives has always been to introduce our clients to third-party solution providers that we believe could bring benefit to their organizations. We are confident that our guest today meets these qualifications. In fact, a few GDS clients currently leverage the services of our guest speaker organization. I am pleased today to be joined by Jonathan Koop, the co-founder of Bankruptcy Debt Acquisitions. Since January 2010, Jonathan has held the position of president and CEO of the firm, which is based in Scottsdale, Arizona. BK Acquisitions has 50 active clients and has serviced 85 companies since its inception in 2010. In his role, Jonathan facilitates the purchase and servicing of bankrupt assets from a variety of entities, including fintechs, financial institutions, debt traders, and government agencies. With extensive qualifications in this field, Jonathan has completed training as an RMAI certified individual, boasts in-depth knowledge of the process of bankruptcy scrubbing and active management of relevant data, and is committed to paying competitive prices and helping clients ensure that risky bankruptcies are removed from active portfolios. Over the past few months, GDS has been reaching out to its clients to discuss how our platform, DataView 360 Medelica, can be used to support their collection and recovery processes with a goal of optimizing the value of collection personnel and putting forward the best collection strategy against each account based on risk. Dealing with bankrupt filings is something all lenders deal with throughout the course of any given year, and is a process typically managed by the collection and recovery groups. With COVID-19, I'm sure you are all forecasting an increase in both personal and business bankruptcies as the impacts of the pandemic continues to work its way through our day-to-day lives. Our goal today is to provide some insights on bankruptcy trends and share the potential benefits that selling bankruptcy debt might bring to your organization. There will be time at the end of the session for questions, which can be submitted via the Q&A button at the bottom of the Zoom screen. This session is being recorded and will be available out via blog post. And it is now my pleasure to turn the session over to Jonathan. And Jonathan, thank you for your participation today.
You're welcome, Rich, and I'd like to thank everyone for being on the call. I look forward to answering all your questions at the end of this presentation. And yeah, I'd really like to thank everyone for the opportunity just to be here today, talk about bankruptcy, and specifically with everything that's going on with COVID and its kind of effect on the bankruptcy landscape. So what I'll start out with here is just kind of an overview of who is filing for bankruptcy and why they are filing, because I think it's a common misconception that a lot of people have, is that people filing for bankruptcy don't have jobs, they don't have any money, and they've racked up a ton of debt, and they are just really just looking for an easy way out. It's quite different when you look at it. Just in general, I don't know how much everyone on the call knows about bankruptcy, but you have to kind of counterintuitive what you think. You have to have some type of money to file for bankruptcy, which kind of makes me laugh because it kind of doesn't defeat the purpose of it. But you do have to have usually between $500 and $1,000 just to go to an attorney and get the bankruptcy process started. So right there, you're looking at a general population of people filing for bankruptcy that either have been employed or might have been employed within the past year. Contrary to what a lot of people think, 80% of bankruptcy filers have graduated from high school and have some type of college experience. They're more likely than the general population to have been divorced, separated, or widowed. So that's kind of the who is filing for bankruptcy. As far as why people are filing for bankruptcy, one of the chief reasons people are filing for bankruptcy is because of an illness and they've gone to the hospital and have racked up a lot of medical bills. That's actually, I think, either the number one or number two reason. that debtors file for bankruptcy. Job loss as well is a very large contributor on why people file for bankruptcy, and divorce too. Many studies confirm that there's a really strong link between divorce and bankruptcy filing. So that's kind of the who and why people are filing for bankruptcy. Next is a slide that I really think is kind of on the forefront of everyone's mind, and that is COVID's effect on bankruptcy. And this is really interesting. With everything that's going on, I think it's everyone's conception that bankruptcies have already skyrocketed, right? And that is not the case at all. Bankruptcies are down around 21% compared to 2019. And this statistic was taken last month. I know that an updated statistic has even showed that it's down as much as 40% year to date compared to 2019. And the reason of this short-term decline is what, kind of counterintuitive what a lot of people think is that it's a result of leniency and reduced collection activities and a lot of government stimulus money that's being pumped into the economy. In addition to that, I think the most important aspect of why this is why these bankruptcy filings are down are just the general shutdown of both the bankruptcy courts and law firms. So up until a couple of months ago, you couldn't even really go into a law office and talk to an attorney about filing for bankruptcy, nor were the courts even open for you to file for bankruptcy. So that's what's resulting in the short-term decline of bankruptcy filings. So I don't know how many lenders are on the call that monitor their bankruptcies closely, but if you've noticed that decline in bankruptcy filings, those are the exact reasons why. Now, on the other side of this, financial and banking crisis that we're going through, or the COVID crisis that we're going through, we're going to really see a skyrocket of bankruptcy filings. If I had to guess, I would think this is going to be closer towards the end of the year or the beginning of next year. And if you just base it on the banking crisis, we're experiencing a slowdown now, and this is the same thing that kind of happened in 2008 through 2010. It's a slowdown in bankruptcy filings now, but there's just going to be a rapid increase on the tail end of this thing. And it's going to be pretty massive. A lot of experts are saying bankruptcy filings are going to double compared to what they were in previous years. And I tend to agree with that. It's going to be a pretty massive spike in bankruptcy filings once everything starts opening up and towards the end of the year and maybe next year, depending on how things go. So that's kind of COVID's effect on bankruptcy. And I really welcome any questions at the end of the presentation because, there's a lot of data out there, and it's, at the forefront of everyone's mind of how COVID is affecting all these bankruptcy filings. What we'll go into now is kind of some general bankruptcy statistics and how it relates to a lot of lenders that are on the call right now. We generally see that around 3% of your charged off portfolio usually falls into bankruptcy. So if there are issuers on the call that currently sell their charged off portfolios, or they service them, or they have some way to kind of monitor them, we usually see that of that charged off portion, 3 to 5% are falling into, of that charged off portion is falling into bankruptcy. In general, the majority of bankruptcies are what are called bankruptcy Chapter 7s. And Chapter 7 is simply just a liquidation of the debtor's assets. The minority of the bankruptcy filings are what are called Chapter 13s. Chapter 13s are a payment plan that the debtor enters into. They're far more valuable than Chapter 7s. And the remaining population of bankruptcies are Chapter 11 cases, which are business bankruptcies. As far as the liquidity goes, and I kind of touched on this earlier, in general, your Chapter 7s, they're very low liquidity because they're based on the debtor's liquidation of their assets, right? Typically, it's hard to ever see any type of assets attached to these Chapter 7s. It's usually 3% or less of Chapter 7s that file have any assets attached. And you're usually waiting as a creditor between 6 to 18 months to see any type of payment on that. So the payments come out pretty quickly to the creditors in a Chapter 7, but they're few and far between. It's really just a needle in a haystack that you're going to get paid as a creditor in a Chapter 7. On the contrary, Chapter 13s are where creditors are going to get their most money, and that is, kind of what's exciting for a creditor when the borrower files for bankruptcy and it's a Chapter 13. What the debtor is doing is they're going into a payment plan to repay their creditors. So what the debtor does, he goes to his attorney, he goes to his bankruptcy attorney and says, hey, I can afford to pay a few $100s a month for the next 5 years. That couple $100s a month goes to the bankruptcy trustee, and then the trustee distributes that couple $100s accordingly between all the different creditors. So all those creditors are going to get a 60-month payment plan that's relative to what they're going to get paid back. And usually what it's going to be around is probably around 20% of what they're owed. So as a creditor, if you're owed $100, you're going to receive $20, but you're going to receive that $20 over the course of 60 months. So if there's any issuers on the phone who have been a part of a bankruptcy plan that's gotten paid out, you're receiving very small checks. You're receiving the checks the old-fashioned way. You're receiving them, through the mail, and you're receiving them sometimes, there can be pennies or, really small dollars on those checks that you're receiving. But the Chapter 13s do, you're entering a recovery payment plan, and you're just put in line, whether you're a secured creditor or unsecured creditor, you're put in line accordingly to receive that payment plan. Some of the quote-unquote landmines with doing these Chapter 13s internally and filing those proof of claims are as follows. Some things like dismissals, conversions, claim objections, adversary proceedings. All of these require different actions by the creditors. So what I'll kind of go into later here on the next slide is as a creditor, a lot of creditors and issuers think that just filing that proof of claim is all they have to do. And that is definitely a good first step. And if you're filing those proof of claims, that's a good thing, and you should continue doing that. But it's really only about half of what you need to be doing. You need to be following these plans and having some type of flag come up if they get dismissed or converted or anything else happens. And that's how you're going to receive maximum recovery as a creditor on these accounts. So what I'll go into now is just the general advantages of having a bankruptcy management partner, and we'll keep this kind of general as opposed to specific to what bankrupt debt acquisitions in my company does. So a bankruptcy management partner is going to help you with a lot of different things throughout the bankruptcy process. So if you're an issuer and let's say you don't do anything with your bankrupt accounts, or if you have a small team working on your bankruptcy accounts, or if you just kind of have maybe an admin in the office working on these bankruptcy accounts, there's a lot of different things that you're probably missing that a bankruptcy specific management partner can help you with. One in particular is to avoid any possible sanctions and errors. During this whole COVID crisis, the court system has become a lot more lenient toward debtors and a lot more strict toward creditors. So meaning they're becoming lenient toward debtors, and if you're a creditor and you're filing a proof of claim and maybe you did it wrong by accident, or you did it you miscalculated the principal, interest, and fees incorrectly. There was once a time where it was a little more lenient toward the creditors, but now it's getting to a point where the courts are really coming down on you as an issuer, and you file these proof of claims incorrectly, and they might, best case scenario, they'll just object to your claim and get it thrown out. But worst case scenario, you might be charged for the fee, the debtor attorney fees for objecting to it, and that's no fun. Another advantage of a proven bankruptcy management partner is just, in general, recovering as much as possible from your portfolio in your bankrupt section of this. I think one of the most important aspects of it is just allowing you as an issuer in your company to focus on your core business. And that's what's most important. When you're hiring a bankruptcy management partner, you're hiring this company to be able to just serve their expertise in just the bankruptcy department and allow your company to do what it does best: lend money, recover money, advertise, and all those really important things that make, your lending institution unique. Kind of what I touched on earlier, bankruptcy recovery is not just filing a proof of claim. You can read on this slide all the different things that go into it, and that's what a proven bankruptcy management partner, that's what you're really paying them for. A proof of claim, whether it takes you 10 minutes to fill out or an hour to fill out. If it's a bankruptcy management partner like us, we fill out probably around 15,000 of these a month with just a click of a button. But what you're really paying for is what's being done beyond filing the proof of claim. What we're going to now is how specifically you as a lender, how your bankruptcy management is going to supplement your collections model in general, right? And we'll divide this up into kind of two sections. One is going to be the pre-recovery section, which is the scrubbing and monitoring portion, and the other we'll go into after that is the purchase and collections or recovery section of that, okay? So a bankruptcy management partner on the front end is going to help us with the scrubbing and monitoring of your accounts. And this can be done in a couple different ways. One can be like a more passive scrub where the issuer is sending a monthly file to the bankruptcy management partner for it to scrub. So this isn't the best way to do it, but it's going to give you a monthly idea of all the accounts that fall into bankruptcy. A more direct, a more active way of doing it is going to be a monitoring process, which a lot of us and other groups like us provide. And this monitoring process is where a company like ours is going to be flagging your inventory and pulling your inventory and backing it into PACER. Now, what PACER is the Public Account Court Record System. And what our company can do is we can bounce the accounts against PACER and tell you which accounts real time are filing for bankruptcy. And that's really important because if you have a collection team and they're getting up in the morning and they are making their collection calls, it's important to know, hey, if that debtor filed for bankruptcy last night, it's important to know that because, via the statute of limitations, you cannot contact that debtor over the phone anymore as a creditor. So that monitoring service is really going to help you as an issuer be more compliant and not waste your time trying to contact these bankrupt debtors. So that's kind of the first kind of, we'll call it the identification portion of, a bankruptcy management service. And groups like us, we provide this for free for a lot of our customers if they sign up to either sell the accounts or have us do recoveries on those accounts. So the recovery section of that can be divided up into two categories. One is the issuer can sell those accounts to the bankruptcy management partner, right? So the advantages of that is that the issuer gets upfront money for these accounts. If you're paying, 10 cents on the dollar or 15 cents on the dollar, the issuer gets the money up front, and then it's the bankruptcy management partner's job to collect those accounts accordingly and recover on those accounts accordingly and try to get the most money they can. The other aspect of that is the collections or recovery side, where it's just a typical contingency recovery arrangement, right? So it's almost like it's similar to any other type of contingency collections where there's a percentage put in at the beginning. Let's say it's 10% or 30%, and it's no recovery, no fee. There's never going to be any type of fee charged towards the issuer if there's not any recovery. So as the payments come in from the trustee, the bankruptcy management partner is going to keep their contingency fee and remit the rest to the issuer. So typical collection arrangement that you would see outside of bankruptcy. That's what you're going to see within bankruptcy, just minus any type of contact towards debtors. It's all done through the bankruptcy court process. So the next slide kind of focuses on specifically what we can offer and what other bankruptcy management providers should be offering, and that's just a real-time portfolio and account reporting platform. And this is really good from a client's perspective or an issuer's perspective when they're going through the compliance, and if there's any account recalls or there's ever any problems, we can show you real time where that account lies within the bankruptcy process. For example, if we bought an account or if we're collecting on an account and that account got dismissed on a certain date, you can log into our system and show that, hey, this account got dismissed on this specific date. Maybe they refiled for bankruptcy on a specific date, and this just provides complete transparency as you go through the entire bankruptcy process. So remember, the bankruptcy process in a Chapter 13 can last anywhere from 5 to 10 years, and that's no exaggeration. So when you're choosing a bankruptcy management partner, understand it's for the long term. The bankruptcy process, just like any other court-appointed process, is painfully slow, and it's important to really choose a trusted partner that provides complete transparency on things like that. Some other considerations when choosing a bankruptcy partner are just general considerations that you would really choose with any partner, whether it be a collection partner or a partner that's doing your scoring or anything else. The IT security policies have to be in place. Very important, especially this day and age with all the compliance and things that's going on. Is the vendor federal and state compliant? Once again, very important. Just like when choosing any of your vendors, you should have your compliance staff or dedicated staff that oversees the vendors go through all the due diligence that they should, and it shouldn't be, I think with a lot of bankruptcy vendors, they might say like, well, we're a bankruptcy vendor and we don't have to adhere to that. That's probably not the best answer, an answer you should accept. Definitely what goes on with the debtor contact is different than what's going to happen with your typical vendors, but in bankruptcy, you are still liable for a lot of different security policies and federal and state policies. So that's really important for you to consider when choosing a bankruptcy partner. On-site audits as well as remote audits, very important as well. You want to make sure to ask a lot of questions. I recommend doing an on-site audit as well. Payment processing is a very big one as well. So since all these payments are coming directly from trustees, they're coming from court-appointed officials, it's really important to have some type of third-party lockbox in place for your bankruptcy partner. We can go into that, and if you guys have any questions at the end as well, I'd be happy to answer them. But in general, when you're seeing a amount, you're seeing very low amounts of checks and a high volume of checks, it's important that you just don't have, someone that's in an office within the four corners of the bankruptcy vendor to be processing those. You really should have a third-party vendor, and that's something that we do partake in, and we take a lot of pride in our third-party lockbox. So with all that being said, I'd really open any discussion questions. I want to thank everyone for their time. I know this is an interesting time with COVID going on, and just the general landscape of everything is changing so rapidly. So if you have any questions specific to COVID and bankruptcy or bankruptcy in general, I appreciate everyone's time and look forward to answering any of those.
Yeah, so Jonathan, this is Rich. Thank you for that informative discussion. We do have a handful of questions, so I'll pose those to you, and you could answer those. The first one, person asks, can you provide some details on what steps you take to evaluate the price that you would put on any BK portfolio that you might purchase?
Yeah, I can definitely do that. So the biggest factor on evaluating a bankruptcy portfolio is obviously going to be whether the accounts are Chapter 7 or Chapter 13. Chapter 7s are very low value. They're typically going to be going for basis points if we purchase them. 25 to 50 basis points, we'll just say a range for purposes of this conversation. Chapter 13s, it might be a wide range, but anywhere between 5 and let's say 15% on Chapter 13s. So that's the most important factor when determining pricing on bankrupt accounts is the chapter. To take it a little beyond that, maybe some nuances of it is the date these bankruptcies were filed. So if we're going to be purchasing these pre-proof of claim, sometimes they're a little lower value than if the claim has already been filed and these have aged a year. So in Chapter 13, there was a slide here that kind of tells you all the adverse things that can happen for a creditor, and I'll try to move to that slide. So everything that happens adversely to a creditor, all these quote unquote landmines are probably going to be happening within the first, I would say, 6 to 9 months from filing. So after that first 6 to 9 months, these Chapter 13s have usually expired everything that's going to be happening adverse to a creditor. And sometimes it's going to be more valuable for you as an issuer to sell them at probably 12 months after the debtor has filed for bankruptcy, pending that there's already been a proof of claim filed. Some other just kind of general tips on what different things that go into the valuation of these is very similar to what you'd see with charged-off portfolios. If it's a payday loan with an average FICO score of 500, they're going to be a lot less valuable than an American Express credit card with a FICO score of 700.
Well, thanks. Second question we have is, do you find that your clients that sell debt are typically doing a one-time sale to you, or is it more like on a forward flow basis? And can you explain a little more what that may mean?
Right, so that's a really good question. Almost all the clients we deal with are on forward flow basis. So it's very important from an issuer's point of view, if you're choosing a bankruptcy partner, you're choosing them for the next year, 2 years, maybe 5 years. So what's important here, when a debtor files for bankruptcy, as a creditor, you only have about a 2 or 3 month window to file that proof of claim. So it's important to engage in a forward flow relationship with your bankruptcy vendor, in that every month you're going to be selling those bankrupt accounts, so you make sure not to miss any of those proof of claim deadlines. So typically always the way we work with lenders is on a forward flow basis.
Great, thanks. Okay, we have another question just popped up. By any chance, do you watch trends on foreclosures as well? And if so, is there anything that you're seeing that may correlate to BK as well?
I would assume that BK bankruptcy filings and foreclosures are pretty strongly correlated. I don't watch it that closely. That would be my assumption. If you want to send me an email afterwards with that question, I'd be happy to check with someone within our team to kind of give you an update on that.
Okay.
It would make sense if they strongly correlate, and especially in the fact that bankruptcies are down right now, and what's matching that is foreclosures are probably down right now with all with everything being forgiven, and I think in a lot of states foreclosures are being halted for the next couple months. So I'd like to get you something more solid on that, but I assume they're pretty closely related.
Okay, thanks. Yeah, another question just popped up. So we know on the slide you're showing, it showed how the percentage of Chapter 7s are almost double that of Chapter 13s. That said, are you typically buying more 13s than 7s? I think the answer is probably yes, but maybe you can elaborate on that.
We buy Chapter 7s and 13s. Clearly, the majority of cases as a whole are Chapter 7s. But keep in mind that the Chapter 7s are so low value, so they're almost, we're purchasing Chapter 7s at 25 basis points, 50 basis points in that range, and 13s and, up to 10%, 15%. So we purchase as volume-wise, as number of cases, we're purchasing more Chapter 7s just because the lenders are coming across more Chapter 7s. But the value when we purchase these accounts, it's primarily all because of the Chapter 13s. Does that make sense?
Yeah, it does. Yeah, thank you. Yeah, we have another question just popped up. What would you say is the number one mistake that creditors make when it relates to bankruptcies?
I would say the number one mistake is failing to understand the proof of claim deadline as a creditor. So it's really important. A lot of times what I have is issuers at the end of the year, they come to me in December and they say, we have 1,000 bankrupt accounts. These bankruptcies have been filed from January to December. Can you let us know which ones you can purchase? And it's always the same answer. From the date that the debtor files for bankruptcy, you only have about 60 to 90 days to file that proof of claim. So basically all those 1,000 accounts that an issuer has aggregated throughout the year as bankrupt accounts, 70, 80% of them are going to be worthless. So the number one mistake, kind of in reviewing, is you have to find a bankruptcy partner and enter into a forward flow agreement with them where you're selling your bankruptcies every 30 days so you're not missing those proof of claim deadlines.
Okay, great, thanks. Okay, we have time for one more question. Okay, have you seen a percent of Chapter 7 filings versus 13 filings change since the pandemic, i.e. the mix? So is the mix of 7s and 13s changed since the pandemic? Do you expect it to change? And if so, where would you expect to see a higher increase? So 7s or 13s?
So I'd have to get back to you on have I seen a change yet. I haven't really looked at the data too closely to see what has changed with the 7s and 13s comparison in the last few months. But I would bet that going forward, Chapter 7 cases are going to be increasing and Chapter 13 cases are going to be decreasing. So keep in mind, Chapter 13 cases are when a debtor wants to enter a payment plan to pay his creditors back over a long period of time, right? So that's going to probably be decreasing, considering that, on the tail end of this pandemic, jobs are going to be lost. People aren't going to have a lot of money. What people are going to be doing is they're going to be going to their bankruptcy attorney, going to their attorney and saying, I don't have any assets. I don't have any money. I want to enter a Chapter 7 and just get this behind me. And I think that's going to result in just a lot more Chapter 7 filings.
Okay. Okay, one more, I promise. Is there a way to increase the claim in a bankruptcy case? Additional legal costs, convenience fees, potential tax income due to inability to pay, et cetera.
Is there a way to increase the claim? You say the question one more time.
Yeah. Do you? Yeah. Where'd it go? Hold on a second. Is there a way to increase the claim in a BK case? Question mark. Additional legal costs, convenience fees, potential tax income due to inability to pay for the debt, et cetera.
I'll try to do the best to answer that question. I think I understand it. As a creditor, you're filing your claim based on how much money is owed to you the date the debtor filed for bankruptcy. So if the debtor owed $1,000 on the date they filed bankruptcy, that's how much you're filing your claim for. You can't file for any more or any less, but I think what you might mean is if the debtor says, hey, I can only afford $200 a month, and as a creditor, you think, actually, that debtor has more money than that. They can file, they can pay $300 a month or $400 a month. You would have to object to the debtor's attorney's plan, and as a creditor, you have a right to do that. It's not easy, and if it's an unsecured loan of $1,000, I wouldn't recommend it. Usually, you see plan objections on the mortgages or the auto loans or loans that are like $10,000 or more.
I want to thank everybody for joining today. I hope you found this as informative as I did. If there are any follow-up questions, please reach out to either Jonathan or myself, and we hope that you and your family remain safe. Thank you, and have a great week.
Thank you.